Welcome to another edition of LIMRA Unplugged. I'm Allison Salka, and I'm here today with Scott Gall. Scott is Head of Investment and Pension Solutions at Prudential. Welcome, Scott.
Thanks, Allison. Happy to be here.
Great. And so we're going to be talking about pension risk transfer. And so that market has really exploded recently. Companies like Baxter International and Lennox International, these mega deals, they've been really all over the news, but there's also a lot of interest in pension risk transfer in the mid-market as well, correct?
Sure. So, we've seen a huge increase in the market over the past 7-8 years, really. 7-8 years ago, the market was maybe $1 to $2 billion in totality. The last couple years, including this year, we're going to see a market in the $25 to $30 billion range. And as you point out, a lot of the big names get headlines, but there's been activity really across all parts of the spectrum and size spectrum. I would attribute it to a few things. Going back, 7-8 years. Education, I think there's a lack of understanding of exactly how these transactions worked. So just to give you an example, the average plan sponsor thought that the cost was around 130% of the liability, when in reality it's single digits, if not close to par. The average plan sponsor thought that there was no capacity in the market to get deals done. 7-8 years ago, the largest deal ever we had seen in decades was like 115 million. And so there's this misconception that you couldn't bring transactions to market. And then finally, there was misconception around timing and how long it takes to get a transaction done. I think most plan sponsors thought it took years and years and years, when in reality, working with an insurance carrier, you can execute a deal in several months. So education was the first thing. I would say funded status has dramatically improved over the past decade. We used to talk about funded statuses in the mid to high 70s, and while they pulled back recently with interest rates, earlier this year we saw average plan in the low 90s. So from an affordability point of view, it was much more possible for companies to transact. Costs have gone up dramatically as well. So if you think about the PBGC premiums, the fixed rate premium has more than doubled, and the variable rate premium is over 4 times what it used to be. And so just cost alone have driven many plan sponsors to look at de-risking. And then maybe finally, we've seen more plan terminations recently, which certainly hits the mid-market. I think companies set on this journey several years ago around freezing the plan, going in an LDI to maybe minimize risk, executing lump sums to remove vested terms from the population. And then really the final stage is a plan termination. And so many companies have begun moving down that path and are at the end. And so that's part of the reason we've seen a lot more activity in the mid-market this year.
So you brought up kind of education, so more sponsors are familiar with the idea or the pension risk transfer concepts. Our research shows that about 8 in 10 plan sponsors are now aware of it. You also mentioned cost being a factor as well. We know that for plan sponsors, 75% say that the cost of benefits is a very big concern to them. So you mentioned a little bit about how pension risk transfer can help, but can you talk a little bit more about that?
Sure. I mean, a buyout transaction actually locks in your costs. So if cost has been a concern of your pension plan, a buyout locks in your costs and reduces all future volatility. And if you actually think about a pension benefit, the benefit actually is defined, right? So you actually know where you're going to pay these individuals for the rest of their lives. What has changed, though, over time, or where the costs have come from, have been, I guess, first and foremost, capital market changes. And if you look since 2000, there's actually been two situations where the average plan has lost 35% funding. The tech bubble in the early 2000s, and then the financial crisis in 08-09. So for most plans, they've had these tremendous costs in terms of interest rates, market volatility, and that cost has been via the funded status taking a hit. We've also seen, like as I mentioned before, costs around administration. So I mentioned PBGC premiums. There's cost to administer the plan, management attention. And so, one of the most popular transactions we see today is what we call a small balance transaction. So those individuals who may have accrued a very small benefit at the company, but if you're paying a high fixed admin rate, or a fixed PBGC premium, those benefit costs relative to what you're paying that individual are quite high. And so we've seen many sponsors focus on that part of the market to execute their transactions.
So it sounds like there are a lot of things that sponsors need to consider. And so as you're having discussions with plan sponsors about this, again, we know that more of them are familiar with pension risk transfer, and about 4 in 10 expressed some interest in doing it. When you're having these conversations, what are the most common questions that you get, or what are the most common concerns?
Yep. Yeah, so you had mentioned 4 in 10. That's quite actually a large population. If you think about corporate pension plans, there's about $3 trillion of pension liability, and if 40% are interested in transacting, that's $1.2 trillion. So it's quite a robust market, given we've been in the $25 to $30 billion range annually. In terms of having more of those companies move forward, I think there's a few considerations. One is affordability. So the average plan today is about 85% funded, and so financial is a primary consideration. How are they going to close that gap, either by taking risk or by funding the pension plan? So financial is one consideration. I think other things they can do, and this is a message that we have in the market a lot, is prepare. So whether you're ready to do a transaction tomorrow or ready in 2 years or 5 years, there are many things you can do right now to begin to prepare for a transaction. The last thing you want to do is wake up one day, interest rates are high, stock market's high, you're 105% funded, and then begin the process. Because if you begin it then, it could take a little bit of time to get ready. So a few things we talk to sponsors about with regard to preparing. One, get your data in order. To do a transaction, we're going to need really solid, clean data on the population, on the benefit, and so there's a lot of work that the average plan sponsor can do today in advance of that. And then secondly, communications, mostly internally. Socializing this idea with the board early and often. The last thing you want to do is show up to the board and say, hey, I want to put some money in the plan and get out of it. And many people on the board may not even understand pension issues. And so we really recommend, again, even if it's not a few years out, begin to socialize the idea, educate internally about the pension plan and the risks that you've had, educate about different options, and then when you're actually at the board, talking through a final proposal, it makes much more sense.
So it sounds like preparation and communication are really important. And so you mentioned how it's important to start preparing a few years in advance, get your board prepared. In terms of employees, are there things that you can do in terms of communication and preparation to make the process easier for them?
Sure. So yeah, one of the big work streams in these transactions is around employee communications. And as you can imagine, the employer wants this to go as smooth as possible. And to make it go as smooth as possible, you have to provide the most consistent, concise information possible to the employees. And I think this has changed over time, but early on in these pension transactions, I think there was this misconception that a retiree loses something, when in reality, you don't lose anything. So any benefit that was provided to you from your company, you retain ongoing, whether it's the form of annuity, whether it's the actual amount, whether it's how you're receiving your benefit, everything stays identical to what you had at your employer. And so we work very closely with the employer to make sure that their communications, our communications out, are very consistent, very clear, so that retirees feel assured that they're going to continue to maintain their benefit and receive their check.
Mm-hmm. Again, so communication being very important to all parties involved.
Right.
Great. And so to talk a little bit about kind of the current economic situation. So we know interest rates continue to be low, and that's putting pressure, or kind of increases the liabilities, which puts pressure on the funded status. What are some of the risks related to a decreasing funded status?
Sure. So I guess maybe I'll address interest rates out of the gate. So I think plans transacting, it's all about affordability. So the size of the market's all about affordability. And so certainly interest rates going down net is not a good thing, because for a lot of plans it hurts the affordability. As you said, it'll make funded status go down. That said, that doesn't mean we think that the market will dissipate anytime soon. Many plan sponsors have actually hedged interest rates already. 60, 70, 80% of their exposure has been hedged through investing in bonds or other instruments. And so, as you point out, as rates go down, funded status will be hit, but the companies that will have the biggest impact probably aren't those companies that are most likely to transact in the short term anyway. And so, we do think that despite low interest rates, that we'll see a healthy market going forward. Your second question around the risks of underfunded pension plans, they're a few-fold. One, just costs. We had talked about PBGC premiums a little bit, but the more you're underfunded, the more you have to pay a variable rate premium. Certainly volatility, and cash contributions could occur. Then there's also other costs too that may not be hard dollar costs, but more management attention, right? If you have an underfunded pension plan, more than likely, if you're publicly traded, you're getting lots of questions on your earnings call. Your stock price can languish or be impacted by an underfunded pension plan. So there's certainly hard costs in terms of contributions, and then not that I view stock price as soft costs, but there's other implications outside the pension plan where the underfunding can have an impact as well.
Yeah, absolutely, because you're talking about things like questions from employees or from the public or perceptions of the company. And these are things that companies may not always think about.
Right.
So in terms of other things companies may not have thought about, what about the role of increasing longevity in terms of the defined benefit obligations that companies have? I know that longevity rates continue to increase for the most part, and so what impact do you see that having?
Sure. So, I've been in the market probably 10 years talking about pension plans, and I have seen a change in the past few years around awareness of longevity. If you were to ask the average company CFO, 2012, what are your primary concerns about the pension plan? They would have started with the stock market, interest rates, maybe the regulatory environment, changes going on, and longevity would have been pretty low. But in reality, the average plan has seen twice in the past 15 years sort of a big mark to longevity. 2014, we saw tables get updated, and they hadn't been updated in over a decade. And the average plan, probably saw 7 to 9% increase in their liability due to that. As you sort of alluded to, now longevity is being looked at annually, and so you're probably not going to see those big, 7-8%, one-time pops. You'll see it sort of meander over time as longevity improves or worsens. But from a company's point of view, the problem with longevity is that there is no natural offset to them at their company. If you think about the stock market, they can go out and purchase an instrument to hedge from the stock market going down. They can do the same thing with interest rates. They can buy bonds, they can buy derivatives, but longevity is really a risk that they have, that there's no natural way for them to offset it, which coincidentally is why insurance companies really like pension risk transfer, because it's longevity risk, which is a very nice complement to mortality risk, life insurance risk. So insurance companies are a natural holder of these types of risks. So from the company's point of view, they just have to consider, how big is the longevity risk. It will certainly pose, some volatility, maybe not as much as, interest rates and the stock market moving, but nonetheless, it is a risk that more and more companies understand now and are looking to figure out how to manage it.
So Scott, thank you very much for an interesting and informative discussion about pension risk transfer in the future. And this concludes another edition of LIMRA Unplugged. I hope you've enjoyed it and look forward to seeing you at the next one.